Chandanam Sheetalam Loke, Chandanatabi Chandramaha, Chandracha Chandana Chaiva Seetala, Sadhu Samgadihi. The meaning of this Sanskrit Subhashita is sandal is cool, moon is cooler than sandal. The coolest of all is the companionship and the gathering of learned people. And today is one of the coolest day as all the learned people have gathered here to refresh their knowledge on direct access. Yeah, very good morning to one and all present here. And welcome to the first day of 2 days National Conference on Direct Access, organized by Direct Access Committee of ICI and hosted by SIRC of ICI. May I now request CA Panarajas, Chairman SIRC of ICI, CA Adhyam B. Geeta, Vice Chairperson SIRC of ICI, CA Ayampalayam Venkadeshan Arun, Secretary SIRC of ICI, Mandava Sunil Kumar, Treasurer SIRC of ICI, CAP Satheeshan Sir, Chairman Direct Access Committee of SIRC of ICI to come and occupy the dais. We recognize the presence of our regional council members, Mupala Subbarao sir, Revati S. Raghunathan madam, and Rekha Umashiv ma'am. As we are celebrating ICI's 75 years of independence, integrity, and excellence, let's honor its past, engage with its present, and envision its future. My ICI, my pride. Let us all raise for ICI motto as a mark of respect to our mother institute. Requesting members to continue to stand for Tamil Thai Valtu also. Thank you. Please be seated. Deepa Jyoti Parabrahma, Deepa Jyoti Janardanaha, Deepo Hartume Papam, Deepa Jyotir Namostute. The traditional lamp is often regarded as a symbol of knowledge, wisdom, and enlightenment. The act of lighting a lamp represents the dispelling of darkness and ignorance and embracing clarity, understanding, and positivity. May I now request the dignitaries on the dais to join the lighting of traditional lamp, an auspicious act which signifies the beginning of our today's event on a positive note. Also requesting our regional council members who are present here to join the traditional lamp. Requesting the speaker, first session speaker, Bhanushekar sir also, to join the lighting of the traditional lamp. Thank you. May I now request Chairman, Direct Access Committee of SARCFSA, CAP Satish sir, to formally welcome the gathering through his welcome address.
Very happy New Year to all of you. Respected Chairman of SARC, Pathari sir, Secretary Arun, and Vice Chairperson Geeta Madam, Treasurer Mandava Sunil Kumar, my colleagues in the Council, Revati Madam, Rega, and Subrao sir, senior members of the profession. Very warm good morning to all of you. Nowadays, generally, everybody is gathered more in strength for the direct tax. Now, GST is the major concern for all of the members, especially youngsters. Wherever GST program, there is tremendous or a number of people will come very high end. But today, we are very happy that so many people are turned around 400, more than 400 registration we received for direct tax. So I hope that till this time, direct tax, importance of direct tax not come to below. Banishagar sir is informing faceless change to nonsense or what may be different things. Nothing can be done. Some of the expenses allowed, some of the expenses eligible to allow, not allowed. Some of the income or expense not allowable, they are allowing. This is the things happening in direct tax. Anyway, we are all of us experts are there. We can hear from them. And first of all, thank you, the Direct Tax Committee of ICI, for giving this opportunity to conduct national seminar under the auspices of SARC. So coming to my duty, I welcome our eminent and expert and a very non-person of MSME, Pathari sir of SARC chairman for this national conference. And our chairperson, vice chairperson, Geeta Madam, is also very active. So I welcome Geeta Madam for this national conference. And Secretary Arun, and he is a very active member for conducting this national conference, helping all of us. So my welcome Arun for this national conference. And Treasurer, the resourceful person of the SARC, I welcome Mandava Sunil Kumar and Subrao sir, Regional Council Member, and Rega Madam, Regional Council Member, Revati Madam. I welcome all of you. And our today's faculty, Banishagar sir with us. And next session is, evening session is going to take by Guruja Rajarya. Then tomorrow we have Mr. Ramnath from Coimbatore and Kabil Goyal from Delhi. We are waiting for experts discussion regarding the taxation. And main thing is the sessions are 3 hour session, because everywhere there are complaints that 1.5 session, only the speaker is getting 45 minutes or 1 hour. Other things are taken care of by the inauguration or other things. So we decided to have a 3 hour session. The session speaker as well as those who are hearing, they can get some clarity in the subject. So decided to only 2 sessions in each day. So I hope you will get more clarity on all the subject. And I welcome, finally, all the members participated in large number. I welcome each one of you for the national conference. I hope that all of us will enrich with the knowledge of latest things of the direct tax. Thank you. And I welcome all the members of staff of the SARC, those who are working day and night for arranging this program. So I welcome each one of you for this program. Thank you.
Thank you very much, Satishan sir. You have set the right tone for today's program through your welcome address. Thank you once again. May I now request the Chairman SARC, CA Panaraj Sirgeri, to deliver his inaugural address.
Good morning and a very warm welcome to all of you again. Before I begin, a heartfelt thanks to all the members who have voluntarily registered yourselves without the compulsion of meeting the CPE deadline. That goes to show, without the efforts, much efforts from SARC to get the numbers, you all know that the national conference should have minimum 400 delegates. So without much difficulty, if it has happened, that is the strength of the subject and the speakers. And you are all interested to learn or relearn or unlearn income tax. As I was discussing with one of the tallest persons in terms of subject also, Bhanushekar sir, this faceless has become baseless also. This is the statement he made, which to have some base to fight it out, here are the stalwarts, as rightly pointed out by our Direct Tax Committee Chairman. We want to have thorough discussion on the issues on which we have doubts or we need clarifications. So the purpose should be served. And we are conducting this program here because of the lack of infrastructure at SARC. And SARC, as you all know, 65 years ago, an old building was purchased. And now, added to that, the CMR, this metro also is coming there. So there are so many technicalities to go for a new infrastructure there. But in my opinion, real pillars of our institute are the stalwarts speakers like Bhanushekar sir. A very warm welcome to you and thank you very much for accepting our invitation to be a speaker here, sir. And I join my colleagues in the council, Vice Chairperson Geeta, Secretary Mr. Arun, Treasurer Mr. Sunil, and Direct Tax Committee Chairman Mr. Satishan, and Mr. Subbarao, Rekha, and Revati, all the regional council members, in inviting you all to this very, what's called very special conference. I would call it very special for 2 reasons. Number one, already I told you, it is not a CPE compulsion, but this income tax subject itself is part of our blood, especially for the CAs who have put in at least 10 years plus, who have lived with income tax. So we want to learn more and more of income tax. That too, the special approach like case laws in corporate entities. That's what is mailed to the SARC by Bhanushekar sir. It will be mailed to you also. Please have discussions here, and after deliberations, please have it for your office also for references, for the future reference. So that is the strength of income tax. For long, income tax, there are no programs are done because of this bombardment of GST and erratic notices of GST and all. Everybody is fully drowned in GST matters, and also other matters wherein because of the automation, we are losing very fast the compliance practices. So how to gear up, all those things are the matters which we are thinking of. Even the institute is focusing on making the CAs global. So the global outreach to the professionals, these are the things which are there in the agenda. But even though amongst all those things, direct tax is always tall and strong. This is the indication of the members registration. By 10 o'clock, more than 50% of the 70% of the attendance is already here. So that goes to show the importance of direct taxes. Then one point I have to mention, as a chairman from a small place in Karnataka, we did regional conference Jnana Sampanna on 12th and 13th of October, for which a huge number of registrations came from Chennai and Tamil Nadu, for which we at SIRC are indebted to you all for your great support there. Regarding the speakers, as I already told you, they are the real pillars of the institute. They are the part of the infrastructure for the institute. But for the speakers, irrespective of whether we have physical infrastructure or not, the great speakers like Banu Shekhar and Gururaj Acharya, Ramnath and Kapil Goyal, there are only 4 speakers for 12 hours. So this will be a thorough deliberation and feast of income tax, direct tax for 2 days, today and tomorrow. With this, a very warm, another time, once again, I welcome you all and I wish you all a very, very happy learning for these 2 days. Thank you very much.
Thank you very much, Chairman, sir. We fully agree the importance of direct taxes. Income tax is the blood of the chartered accountants and the need for the global reach of chartered accountants. Thank you for your inaugural address. We recognize the presence of CAE Palgunu Kumar, our past chairman of SIRC of ICI. So with that, we have come to the conclusion of the quick inaugural session. May now request CAAB Arun to formally propose vote of thanks for this inaugural session.
எல்லோருக்கும் வணக்கம். Respected Chairman of SIRC Pathari sir, Vice Chairperson Geeta Madam, Treasurer Sunil Kumar Mandava, and Direct Tax Committee Chairman Sadishan sir, my council colleagues Revati Madam, Rekha Madam, and Subbarao sir, the past Chairman of SIRC Balgana Kumar sir, senior members. Warm good morning to one and all present here. It is immense pleasure to be propose this vote of thanks in the direct taxes national conference, since this is the period where we are not bothered about the CPEs. Even then, as said by our chairman, we get a large number of registration. We thought that when we organized this program, we thought that having section-wise discussions and all, it is everywhere, it is going on. So we want to have the case study basis sessions. So almost all the 4 sessions are structured that way that only the case studies are going to be discussed. With this, I thank Direct Taxes Committee for giving this opportunity, and also the office staffs to getting, they are tirelessly working to get this program organized. Mr. Our SIRC head Ravichandran sir, and a young and officer of SIRC Raghuman, and other supportive staff of SIRC. I thank each and everyone, and also for the MMA for supporting us to have the program here. Sir, once we visited at the time of MSME conference to have the conference here, my chairman wants to have at least one program in this MMA hall because of their infrastructure. So with your all support, definitely very soon we may have our own facility in our SIRC. So with this, I thank each one of you for participating, and happy learning for the next 2 days. Thank you.
Thank you, Arun sir. With that, we have come to the conclusion of the quick inaugural session. May now request dignitaries to take the front rows, please. We are quickly moving to the first technical session. The first technical session is on case study on corporate entities. We have with us a CAT Banu Shekhar sir. May now request Banu Shekhar sir to come and occupy the dais, please. Requesting CAS Revati Raghunathan, the chairperson of the first technical session, to accompany Banu Shekhar sir to the dais, please. CAT Banu Shekhar, a qualified chartered accountant in the year 1994, enrolled as an advocate in the Bar Councils of Tamil Nadu, associate member of the Institute of Cost Accountants of India as well. Banu Shekhar sir has contributed articles on direct taxes, international taxation to several tax journals, including Consolidated Commercial Digest, published by the publishers of Income Tax Reports, and Taxman, Tax Referencer, and the Income Tax Review, published by the Chamber of Tax Consultants, Mumbai. Have argued in a number of landmark cases before various benches of the Income Tax Appellate Tribunal across the country, which have resulted in establishing precedents for many common contemporary issues. Banu Shekhar sir has have argued in a number of cases in various benches of the Income Tax Settlement Commission, also an author of Handbook on Assessment Procedure and under Income Tax Act 1961, First Assessment under the Income Tax Act, served as a visiting faculty at the Institute of Chartered Accountants of India, Company Secretaries of India, and the Loyola Institute of Business Administration on direct taxes. He is actively participated as a trustee in Brain Stress session organized by the branches of ICI, participated in training programs for the commissioners of income tax conducted by the Regional Training Institute of Income Tax Department, a former chairman of Direct Taxes Committee of Hindustan Chamber of Commerce. He was also served as the chairman of Fiscal Laws Committee, SIRC, and served as a co-opted member of the Direct Taxes and the International Tax Committee of SIRC of ICI. With this brief, I have great pleasure in welcoming CAT Banu Shekhar sir to handle the first technical session, CA Studies on Corporate Entities. May I now request Revati S. Raghunathan ma'am to present a shawl to Banu Shekhar sir. Requesting Rekha Umashu ma'am to present him with a health bouquet.
Shri Guru Pyo Namaha. Good morning to Banu Shekhar sir, my council colleagues, and all my professional colleagues here. A very tough job I've been given to actually give a few introductory remarks about what Banu Shekhar sir is going to speak on. He's going to talk on the taxation of corporate entities, discuss case laws. And I think it's going to be a very highly interactive session, knowledge sharing session. But unfortunately, I have knowledge up to section 80C, which I prepared for intermediate taxation. After that, I don't seem to have progressed too much. And Banu Shekhar sir, in his avatar as a chartered accountant, used to intimidate me. And today, as an advocate, I'm petrified to talk in front of him. So, and I'm a person who now practices insolvency and deal only with corporate debtors and not corporate entities. So I am also eagerly waiting to actually hear what sir is going to share today. So I'll not stand between him and all of you. We are all waiting, geared up to actually update our knowledge over the next 2 days. I think that this early fulfilling of the CPRs may have been one of the factors, but I'm sure it is because of the lineup of speakers that everyone has come for the direct taxes seminar. Because normally, if you see, it's only the GST seminar which attracts people nowadays, or something on faceless assessment. But today, the tall personality here has managed to attract quite a lot of people, and I'm sure that we are all waiting to hear him talk. Thank you very much, everyone, for coming.
Chairman of the Regional Council, office bearers, other regional council members, respected members of the profession, and my dear friends. At the outset, I must say that what Madam Revati said, she was saying she is petrified. I was telling her this morning also that you don't have to be petrified because I don't fight unless I'm paid. And I have not been paid to fight with her. So why would I start a quarrel with anybody? That was what I was telling her in the light of it. But then, be that as it may, she is a good friend of mine for a long time, and there is absolutely no reason why Madam should be petrified. Well, as far as the subject of taxation is concerned and the topics that are there, I really think that after the faceless assessment, there are a lot of challenges that we are facing. Particularly after the first appeals became faceless, things have become even more challenging. Because of one simple reason, to the best of my knowledge, there has been absolutely very little disposal at the level of the Commissioner of Appeal, particularly wherever it is faceless. A. Two, we are also having artificial intelligence picking up everything for the purpose of scrutiny. Well, while we appreciate the fact that artificial intelligence can think in different ways, a lot of information I find is just going past. We are personally aware of certain transactions and we believe that these should be captured, but unfortunately are not being captured. And as Chairman put it a little earlier, there are so many instances where additions we believe should happen, but they don't happen. Why, I don't know. And there are instances where we believe that it is so simple and straightforward. For example, I have a draft assessment order with me made by an officer where the officer has made an addition or proposed an addition under 80IA, disallowing 80IA on certain excessive payments. Matter is covered by Supreme Court. What more can I give? What more can I give? If Supreme Court is also not acceptable, then what will be acceptable becomes a challenge. Well, these are the kind of orders that these days we are facing. And very unfortunately, we are stuck in a situation where Commissioner Appeals hardly dispose matters. And mostly, if you see how Commissioner Appeals dispose, they are either covered matters. For example, a 3615A matter gets disposed of, or they send 5 notices to some email, which email is probably not even in operation. And then they say, there is no response at all. We are dismissing the appeal ex parte. This is called multiplan. In tribunal, they call it multiplan. Actually, the name of the assessee is Multiplan Limited, where the tribunal for the first time decided that they can dismiss an appeal ex parte for non-appearance. So it suited, the name suited because the same person will come back, the appeal will get restored, one more appeal will get disposed of. So that became multiplan. The name well suited. Now, CIT appeals are citing multiplan, but time and again, the tribunal and the courts have been holding that multiplan cannot be used by the Commissioner of Appeal. He has to decide on merit. They seem to be taking the simple route. We are also threatened with 263 today. Many things which should come in scrutiny don't even come in scrutiny because everything is artificial intelligence. And the officers also, I was addressing at the NADT the other day, and I was talking to a few commissioners and range heads, the additional commissioners. And they were saying, sir, we are not able to guide people because they are all operating faceless. Though we are supposed to be guiding as range heads, it doesn't happen these days. It is not as though departmental officers are happy with what is happening either. So this is something where we are stuck with a big challenge. And we also have this concept of 143.1, where they simply say any variation between audit report and the return of income will be added. Well, I have 100 cases where there are mistakes in the audit report. I have not seen a single instance where a 143.1, they give you an opportunity. They say, kindly send your response. I have to date not seen a single instance where the 143.1 addition proposed has been dropped after looking into the response given by the SSC. Well, today the endeavor is only to talk about taxation of corporate entities. I understand that tomorrow Ramnath, a good friend of mine again, would be speaking on predominantly on non-corporate entities. I will largely talk about issues that have been either decided or about issues where people have come to me seeking opinions, where I have mostly settled written opinions, and where I find that more than one person has come to me with the same opinion, for the same opinion. Of course, I have 2 bills paid. That's the advantage. So having already raised more than one invoice for it, I'm ready to share it free. That is the agenda now. So this is how I have chosen my case studies. Now, before I proceed, first, there is a small apology that I need to give. The paper was sent only last night at 11:30 to the SARC. Therefore, there will be a definitive delay in it reaching you. Now, what I have done is, I have taken some small case studies. In the paper that is circulated, the case study is also there. The reference material is also there. So if I am referring to a decision of a court or a tribunal or whatever, that will form part of the paper which the chairman has promised will be circulated in a short while by email to all the participants. So nobody needs to bother about taking note of any of the citations or any of the circulars or any reference that I am giving. You can forget about it. That is there in the material that will be circulated. The first of the case studies is a rather simple one. Basically, again, 3615A, where what happens if it is paid beyond the date stipulated in the relevant act, rule, notification, or order. Now, earlier, there were decisions of various courts and tribunals where they said that if it is paid beyond the time stipulated in the relevant act, rule, notification, or order, but paid within the 139(1) date, even the employee contribution to an employee welfare fund will be allowed as deduction. They made an amendment with effect from assessment year 21-22 and provided that thereafter it will not be allowed as a deduction. But unfortunately, the Supreme Court in a case called Checkmate Services, even prior to 21-22, held that it should be paid within the due date stipulated in the relevant act, rule, notification, or order. I say that is unfortunate because so many decisions came in favor of SSC, but this reversed all of them. But if you personally ask me, I would think the view taken by Supreme Court is the correct position in law. I don't want to enter that debate. There are friends here who I know personally, who don't agree with the view that I took, but you agree or don't agree, Supreme Court is steering. So, well, what view I hold or what view you hold is irrelevant. Supreme Court now says this. Now, the question that arises is, prior to the amendment, there have been instances where adjustments have been made under 143(1) in respect of the 3615A disallowance. Now, if the adjustment was made under 143(3), no questions, checkmate will squarely apply. But if the adjustment was made in terms of 143(1) proceedings, what is the position? Now, here, there are conflicting decisions of various tribunals. To the best of my knowledge, there is no high court so far. The Mumbai tribunal and the Jaipur tribunal have taken a view that 143(1), it cannot be done, Whereas to the best of my knowledge, again, all other benches of the tribunal have taken a contrary view, saying that it can be done under 143(1) prior to amendment. Post amendment, the question does not rise. Obviously, it can be done. This is the first issue that I have raised. Now, the second issue is with regard to depreciation on goodwill. Now, all of us are aware that there was a decision of the Supreme Court in a case called Smith Securities, where the issue was with regard to allowability of depreciation. Now, basically, if you look at the provisions of 32(1), it provides for allowing depreciation on intangibles as well, and provides that it will be allowed in respect of any know-how, patents, trademarks, licenses, copyrights, franchises, or any other business or commercial rights of a similar nature. Now, largely two debates have been going on. One is with regard to depreciation on goodwill, whether it can fall within any other business or commercial right of a similar nature. Two is with regard to the aspect relating to non-competency. That again, the debate continues. In Smith Securities, Supreme Court in no unclear terms said that depreciation on goodwill will be allowed. Thereafter, there has been an amendment made where they provide that depreciation on goodwill will not be allowed. So we leave that for the time being, that post amendment, there can be no debate that depreciation on goodwill will not be allowed. But the larger question is, what happens in respect of the period prior to the amendment? Now, supposing it has been allowed at any stage by an assessing officer or by any appellate authority, and there is no further appeal pending, no debate can arise, and therefore the assessee will continue to enjoy the depreciation on the goodwill. Of course, if it is prior to the amendment, there should still be no difficulty, even if somebody rakes up the issue, because the issue is covered by the Supreme Court in Smith Securities. Now, that is one part. Now, post the amendment, there has been one thought in my mind, which I thought I should share with you. Now, what is goodwill? See, technically, if you look at it, if I say goodwill, as an accountant, I understand that it is my inherent capacity to earn profit. Right? It is my capability to earn profit by acquiring a particular entity. That is all I would understand it to be. Now, basically, nobody gets a right or a capability to earn profit without anything available in it. It may be intangible. So what I get really is a brand name which enables me to make profits. No difficulty. Brand is specifically provided for. Depreciation will be available. But what else would be there? Largely, I would think it is a customer base. Now, is it possible for me to bifurcate these into different segments instead of just calling it goodwill? The right to access customers, right? The right to execute orders which are already available with the company, which it is already acquired. Can I bifurcate it and claim depreciation? I think to a large extent we should be able to do it, and depreciation may still be available. Of course, on non-compete, the debate seems to be because the department believes that there is no right in a non-compete. What happens is, if I buy a business from you, I enter into a non-compete agreement with you in such a manner that you cannot do a competing business within a particular locality and for a particular time. This is what I do so as to ensure that you don't compete with me in the business. Now, the department feels that there is no right that I acquire similar to a brand or a franchisee right, which are all positive rights. The department believes that non-compete is a negative right. I prohibit you from doing something. When I get a brand, I am permitted to do something. When I get a non-compete, I don't get a right to do anything, but I get a right to prohibit you. Therefore, department seems to be taking this view. Fortunately for most of us here, the Madras High Court in Pentasoft Technologies has held that depreciation is available on brands. But unfortunately, there is a Delhi High Court in Sharp Business System where the Delhi High Court takes a view that in respect of non-compete, depreciation is not allowed based on the theory that I just said. This is just by the way. Now, the next aspect is with regard to goodwill, which I just spoke, which is not a defined term. So we can probably try and split this into different items, at least for future, when we enter into agreements, because now depreciation on goodwill is not available because of the amendment. The next aspect is with regard to claim of expenditure as to whether it is revenue or capital. Basically, the example that I have taken is that I am a manufacturer of ice creams and I sell the ice cream through various outlets, or I appoint franchisees, let us say. And the franchisees, adapt the whole setup for the purpose of selling the ice cream, in which they incur some expenditure by way of maybe partitions, maybe furniture, maybe laying of electrical cables, maybe various other kinds of expenditure. And more often than not, these are also likely to be in premises which are rented. Now, the question is whether these expenses should be taken as capital in nature or revenue in nature. Now, most of the decisions that I have seen, including decisions where I myself have had opportunities to argue, we have been able to convince the courts or the benches that it is revenue expenditure. Now, unfortunately, again, we have one decision of the Madras High Court in a case called ETA Travel Agency, where they have held it to be capital expenditure. Now, how do they hold it to be capital expenditure? See, if you look at the provisions of 32(1), there is an explanation 1, which says that if there is any expenditure incurred, and if it is in the nature of, I will probably read the exact words. It says where the building is not owned by him, in respect of which the SC holds a lease or right of occupancy, and any capital expenditure is incurred for the purpose of business or profession, or construction of any structure or doing of any work in or in relation to, or by way of renovation or extension or improvement to the building, then the provisions of this clause shall apply, which means that you are entitled to depreciation. Now, where in my understanding, the Madras High Court decision in ETA Travel Agency requires to be reconsidered, is that if you look at most of the other decisions, they are all in favor of assessee. They have looked into whether the expenditure is first capital in nature. If it is capital in nature, then by virtue of 32(1), explanation 1, you are entitled to depreciation. But if the expenditure is revenue in nature, then I don't even have to look at explanation 1 to 32(1). It should be allowed under 37(1) itself. I think that decision of the Madras High Court in ETA seriously needs to be reconsidered, because there is a plethora of other decisions of the Madras High Court itself, where they say that the expenditure is revenue in nature and will be allowable, even after considering the first explanation to 32(1). Therefore, I would think that this is one decision where we need to be careful about. So when we are putting forth our case, we need to make it clear and try to distinguish ETA Travel Agency to say that the expenditure incurred in that case was held to be capital. And therefore, the High Court held that you are entitled to depreciation. But here, so long as my expenditure is revenue, for example, if I lay cables, what do I do thereafter with it? What is the asset that comes into place? See, when I say a particular expenditure is capital, then I should get an mere enduring benefit is not enough. An asset should come into place. And so long as that is not there, I would think the allowability should still be there. The next aspect that I have taken, the fifth issue, is with regard to 43A and the availability of enhanced depreciation on 43A. Now, 43A deals with exchange rate differences and says that if the exchange rate difference is related to the cost of an asset, either because of borrowing or because of deferred payment for the asset, then it should be capitalized to the cost of the asset as and when the amount is actually paid. So you cannot at a year end make a notional adjustment to the cost of the asset. They want you to increase or decrease the value of the asset at the time of payment. Say, for example, today I take a loan and buy an asset for which I have to pay in USD. Today it is 82 rupees a dollar. When I actually pay, if it is 85 rupees a dollar, then the 3 rupees should be adjusted to the cost of the asset when I actually pay. Until then, no adjustment is warranted. First of all, I have for once failed to understand how to make this a workable proposition. Because when I buy an asset, what I do is I take a value. Say, supposing I'm buying it today, I will multiply it by 82, which is today's value, and capitalize it, take it into my block of assets. Isn't it? I will take it into my block of assets. Next, what happens? I start claiming depreciation on that value as which is included in that block. Now, after 4 years, let us assume I pay some amount. What should I do? They say you must add it to the cost of the asset. Now, if I add it to the cost of the asset, I have to rework the depreciation for each year again. So logically, they should have said, you add it to the remainder of WDV of that block, so that I will get the enhanced depreciation from that year. In practice, this is what I tell people or advise people to do. Add it to the block. If the officer wants to add it to the cost of the asset, it is his problem. You add it to the block, that is the only workable solution to this. Therefore, I have found that this itself is the first challenge. But the issue that I have raised is one step ahead. Am I entitled to additional depreciation? On the 32(1)(2)(a) allows me to claim additional depreciation. Am I entitled to claim the additional depreciation on the 43A adjustment that I make? Because when I bought the asset, I bought it for 82 rupees. When I actually pay for the asset, it has become 85. Now I am entitled to additional depreciation, not merely on 82, but I should be entitled to additional depreciation on 85. I really don't know how arithmetically this will be possible. Unless it falls within same year, the first year, or unless somebody is going to rework the cost and start claiming depreciation from earlier years, which means the next problem is, can you file a revised return? If time is available, maybe yes. Otherwise, you have to go to the board under 119(2)(b). And going to the board is a very peculiar thing. Some 10 days back, I went for a huge 119(2)(b) to the board. I went to Delhi. Right? Delhi, there was fog. At 11:30, I was told that the flight will not go any further. It was in Jaipur. I managed to get down at Jaipur, get a room 30 kilometers, no rooms available, because flights had all been directed to Jaipur. So I managed to get a room at about 12:30. 1 o'clock, I managed to lie down. 1:30, I slept. 3 o'clock, tea came. Got up, took the next flight to Bombay, Bombay to Chennai. And the return flight costed a bomb. So 119(2)(b) is not so simple. This can be one additional problem if your hearing is posted in December, January. Right? Even otherwise, getting a hearing posted in the board itself is such a difficult affair. I really don't know. Theoretically, I can answer it very simply. You are entitled to additional depreciation. How? I don't have the answer. It is a big difficulty. But if you have opted for the 115 BBA rates, that is at the 22%, then understand that you are not going to be entitled to additional depreciation because you are barred from it. The next issue is with regard to the allowability or the claim of unabsorbed depreciation of earlier years, where I have discontinued that business and started a different business within the same entity. Now, I see absolutely no prohibition in section 32 in respect of carrying forward and setting off depreciation, even if it is a discontinued business. A. In fact, even if it were a business loss, earlier you had a condition that if the business is discontinued, you are not entitled to the claim of depreciation. But post the amendments made in 72, I think that is not an issue. You are entitled to set off even brought forward business losses, even after the discontinuance of the business, but within the same entity. Now, the question is with regard to unabsorbed depreciation gets a little more interesting because you have a decision of the Supreme Court in a case called Virmani Industries, where the Supreme Court has beautifully explained that unabsorbed depreciation is never unabsorbed. When it comes to the next year, it becomes current depreciation. Right? So that is how you get it carried indefinitely. Of course, there were amendments in between. Forget all those amendments we are talking of today. So it becomes current depreciation, which automatically means that you are entitled to carry it forward indefinitely. Not only that you are entitled to carry it forward indefinitely, you are also entitled to have it set off against any other head of income also. For example, let us say an individual businessman has started a business. He has an unabsorbed depreciation. At some point, he understands that he is no longer good for doing business. He decides, okay, I will go to employment. Or I will live on, let us not take employment because the next confusion, can business losses be set off against salary? I would still think business losses cannot, but unabsorbed depreciation can. Because unabsorbed depreciation is governed by 32(2) and business losses are governed by 72. The prohibition is there. This does not even fall within the ambit of the subhead set off and carry forward and set off of losses. It is clearly 32(2) independent. It works on an independent footing. Keeping that aside for a moment, let us not get into one more confusion. Let's assume I decide to live on my house property. Can I set off these losses? The answer is yes. In fact, that's exactly what Virmani Industries had said. The next issue is with regard to a tonnage tax company. Now, we are having huge problem in all these shipping companies where they follow the tonnage tax. Now, what happens is the tax auditor in the Form 3CD refers to various items which are covered by various sections. For example, 43B, he lists out. 40A, 1A, the chartered account lists out. The late payment of 3615A, whatever it be, all these are given in the tax audit report. Now, what happens in 143(1) proceedings itself is more often than not, the CPC captures this and adds it as part of my income. Now, the provisions starting from 115 VA in regard to tonnage tax are very, very clear. It says these provisions are applicable notwithstanding anything contained in 28 to 44. So none of the allowances or disallowances contemplated by 28 to 44 are applicable to a tonnage tax company. Now, the tonnage tax company may make 100 crore profit, but it will pay tax on a multiplier factor. Income is determined. This is like your 44 AB, whatever, in respect of these transport companies, AE. It's very similar to that. So what happens is that the assessee offers an income with a multiplier factor being the tonnage capacity of the ship. So if the ship's tonnage capacity is 50,000 metric ton, 50,000 into whatever is the amount stated is the income. Profit and loss account is irrelevant. Now, whether you make 100 crores or you keep the ship idle or you incur losses, you pay tax on the tonnage tax. That is all. If you keep it idle and don't earn any income also, you pay tonnage tax. This is again similar to 44AE. 44AE does not talk about plying the vehicle. It talks about your ownership of the vehicle. Same here. What happens in 143(1) proceedings is that the CPC now makes disallowances because there is a mismatch between the 44AB report of the chartered accountant in Form 3CD and the income offered. Huge addition. 20 crores, 30 crore, 40 crore numbers are there. But then we are struggling. Now, if you file a 154, what the department says is, no, you modify your Form 3CD, which chartered accountant will be willing. I am not. Even when I was in practice, I would not. I will not advise anybody either. Because the Form 3CD says, you give me the list of items which are governed by 43B. It does not ask me, is this applicable to assessment? Whether it is applicable or not, I must give that list. So this is another problem that the department has been raising. 143(1), 143(3). I have so many 154 spending. I have so many appeals pending. Everything is lying. Nothing happens. But this is reality. So thankfully in 44AE, which affects small SSEs, there is no requirement for a tax audit. So you are safe. Had there been a requirement to file a tax audit report in 44AE, same problem would have been faced by all of us there also. The next is with regard to the freebies. Again, this is basically with reference to pharma companies, where the Medical Council of India came up with a notification sometime in January 2016, saying doctors should not accept any gifts or freebies from the pharma companies. Right? Now, I have myself argued so many cases here and successfully saying that what is prohibited is the payment being received by the doctor. There is no prohibition on the company paying. The Medical Council of India's guidelines don't bind the pharmaceutical companies. They bind only the doctors. It is very simple. See, if you go to 37(1), it says expenditure incurred for an offense which is otherwise prohibited by law. So if you go and bribe a policeman, it is an offense and it is prohibited by law. That expenditure will not be allowed. Simple. But if you are the purchase manager of a private company and to place a particular purchase order on somebody, you are paid some money without the knowledge of your company, then the law as it stood then would have prohibited this from being received by you by the employer, but the law did not prohibit it. It is not an offense. It is not prohibited by law. It is prohibited by your terms of employment. Right? Likewise, the pharma company is not governed by this. Therefore, we were arguing that these are allowable. And tribunals and courts were taking a favorable view. Again, unfortunately, Supreme Court in Apex Laboratories held that, no, these are all ethical things. Ethically, it is incorrect. I don't know where the law goes with ethics. Right? See, in fact, we have always said equity and law are strangers, particularly tax law. Equity and tax law are strangers. They are not enemies, but they are strangers. That much we will have to accept. Now, that being so, we have a decision on Apex Laboratories. We also have an amendment in 37(1), which says that even if it is prohibited by terms of employment, still the disallowance can operate. All that said, the questions are, what if a doctor still receives money from a pharmaceutical company? Whether it will be disallowed or it should not be disallowed is the issue. Well, the answer to this question is very simple. If you see the notification issued by the Medical Council of India, it permits gifts up to ₹1,000. Rather, it does not say I permit. It says 1,000 to 5,000 gift censure. Then 5,000 to 10,000 suspend. These are the punishments. So we are presuming that up to 1,000 there is no prohibition. So even now pharma companies are taking a view that if they are only giving, say, tea coasters, they are giving some, pen stand, etc., which you all see in most of the doctors' clinics when we walk in. Most of these will be within 1,000 rupees and these are allowable. Right? This is one point of debate. But then if you read Apex Laboratories very closely, we can still be in danger because it says ethical, even before amendment. Right? So it could still be a dangerous view to take. And remember that this does not affect only the pharma company. Though this decision of Supreme Court was for a pharma company, it will affect even if you are a distributor. See, what happens if pharma company appoints you as a distributor? Now, see, pharma companies have also been approaching us with various mechanisms because doctors won't write your medicine. Simple. Doctors don't run a profession today. I don't know how many of you are having doctors at home. I have. Doctors don't run a profession. They run a business. It is clearly business, right? If we are saying that any of these so-called hospitals that we have today, corporate hospitals are running a profession. I saw one advertisement. Come replace your heart. For what? Somebody says your knee can be replaced. You can do it very easily. It is only half an hour process. So why should I replace my knee? Why should I replace my heart? I wouldn't understand. See, if you are running a profession in the first place, I would think you should not be advertising. And literally everybody is advertising today in some manner or the other. And doctors don't write medicines. See, I remember many of the medicines that I have been taking or buying for my family members, or I have myself been consuming. 50 years later, they say this causes cancer, so we are banning it. 50 years later. Honestly, when I was 15 years old, the medicine that I bought for my eldest sister, I have bought for my youngest daughter also. Now that medicine is banned. I am now 55. 40 years I have been buying this for every lady in my family. And now they say it causes cancer. I don't know what I have done. Right? And doctors have been prescribing it. So for 40 years, you have been researching and now only you found out it causes cancer. Be that as it may. Well, unless an service is rendered by the medical practitioner. For example, we have cases where the medical practitioner refers a patient to a hospital, a multi-speciality hospital, and he is closely associated in the treatment of the patient. And the multi-speciality hospital pays the doctor, the medical practitioner. In which case, I would think it is allowable because the service is rendered, but the burden is on you to show that service was rendered. If that is so, then you can still get the expenditure allowed. In every other case, I would think the expenditure cannot be allowed. One more aspect or one more dimension to this is, there have been cases where medical practitioners have been claiming various expenditures for travel, etc., to propagate the medicine. Now, if such kind of benefits are given, then the provisions of 194R come into play again. The provisions of 28(4) come into play. Now, these are benefits or perquisites derived by the doctor. Even if, for example, I call all of the doctors and give them free meal, and I talk about my medicine, the free meal is a benefit or a perquisite. If I provide them conveyance, traveling, see, the traveling can be huge. The doctor could be located in some other part. He will be located in Bombay. He will be coming to Chennai. The airfare is borne, business class, borne by the pharma company, right? Now, I would think in all the cases, in 28(4) also it should get taxed in hands of doctor. And in any case, the pharma company has a responsibility under 194R to deduct tax at source, because it's a benefit or perquisite accruing to a person in the course of his business or profession. Right? So that is the next aspect. The ninth issue is with regard to discontinued businesses. Now, what happens is I continue to run the entity, but for some reason I have discontinued the activities that I have been carrying on, probably because it was not profitable. And I am trying to recover the business or recover my old dues. And I continue to incur expenditure by way of rent, by way of electricity, by way of staff salaries, because I need to run at least skeleton staff. I need to run at least skeleton staff. Now, invariably, the department would come up saying that these expenditure are not allowable. Now, department very often is confused between commencement of business and commencement of earning income. Let us say I qualify as a chartered accountant day before yesterday, result came. I apply for my certificate of practice, get my certificate of practice, open the shop and keep it. I am not supposed to solicit anybody until you come to my office and tell me, sir, please, I have to wait. Now, let's say this wait goes beyond March. I get my certificate of practice in January. This wait goes beyond March. I will have no income. I will have expenditure. Right? Can I claim it? The answer should be yes. It doesn't mean that for 3 months you should not drink tea or coffee. Right? Nothing. It means nothing. It does not mean that you must go walking. You should not go in a two-wheeler or a car. No. I think you are entitled to the depreciation on the car if you want to have however big a car you want. In fact, I have one case where the assessing officer said, this is a very expensive car. Nobody needs to use this kind of car for his business. If he is going to run my business, then what do I do? So I told him, sir, I will do one thing. Evening when the client goes, I will ask him to give the key to you and you run the business. I will come and sit here. Because you seem to be in a position to take decisions not only about your office, but about everybody's office. So I would rather sit there than sit here. Even if it means lesser income, it is all right. Even if it is faceless, it is all right. But officers today sometimes take such extreme views. Why should you have such an expensive car? That is my choice. That is not the choice of the officer. But at the same time, coming back to the issue in hand, it is very simple. So long as you have not discontinued the business, but suspended the business, I think the expenditure will still be available. There are several decisions, including that of the Madras High Court, which I have cited. The next issue is a very, very common issue that I have at least 20, 30 different cases on the same lines, probably, including 263 notices, etc. Simple CSR expenditure. CSR expenditure is to be disallowed. But assuming that the said CSR expenditure qualifies for ATG, can I claim ATG? Now, department is taking a view that I am not entitled to ATG, but the prohibition is in 37(1). The prohibition is not that it should not be allowed under any provision of this act. It says it will not be allowed under 37(1) as an expenditure incurred wholly and exclusively for the purpose of the business or profession. That is all. If I am entitled to ATG, I am entitled to ATG. There are a series of tribunal decisions on this which I have given, where all the benches have taken a similar view that ATG is available. The next is again applicable exclusively to NBFCs, where NBFCs, though they are following the mercantile system of accounting, as per RBI regulations, they don't account for their interest on NPAs. Now, the question is that interest on NPAs which they don't accrue, whether it will constitute income or not. Why I took this issue was because Very recently, I saw the Telangana High Court in State Bank of India's case, where the Telangana High Court says the rules really governing the company under RBI are different. Income tax is different. In income tax mercantile system, you must offer. I don't know whether I'll get it at all. So actually what somebody should do is offer and claim bad debt. Same here. There is no prohibition in claiming in the same year. And TRF Limited Supreme Court says the minute you write off, it should be allowed. Probably that should be the solution. As and when you recover, you offer. But I was surprised with this Telangana High Court because I saw two decisions of the Supreme Court. One in an SLP where the Supreme Court from the Delhi High Court dismissed the SLP of the department, saying that the Delhi High Court was in favor of SSC. They dismissed the SLP. But that apart, there is one other decision in a case called KICM investment, which arose from the Calcutta High Court, where in a civil appeal, the Supreme Court has allowed this matter. Right? In a civil appeal. See, if they dismiss an SLP, it doesn't lay down the law. It is not the law laid down by Supreme Court. It is only applicable to that particular SSC. The SLP is dismissed. That's all. No further dispute for that SSC. If I must put it in very legal terms, that is a decision which is applicable in personam for that SSC, not in rem, not for all SSCs. But if an order is passed in a civil appeal, unless the court says so, it is applicable in rem. It is applicable to the world at large. Therefore, I would think the issue stands covered squarely by Supreme Court, and the Telangana High Court will have no implications at all. I think the Telangana High Court, if I must again put it very legalistically, is per incuriam, without considering the decision of the Supreme Court in civil appeal in KICM Limited. This is the next issue. Next is with regard to surpluses arising from keeping monies in bank deposits, whether these are to be treated as business income or other sources. Now, the Supreme Court in Tuticorin Alkali would say that if you place money in deposits and earn interest income, then the interest income is to be taxed as income from other sources and not income from business. In fact, the facts of Tuticorin Alkali are very interesting. What happened was that the SSC before commencement of business had placed money in FDs and was also buying machinery. He was also incurring interest expenditure. So he wanted to set off these two. The Supreme Court said, no, this is other sources. That is, if at all, governed by 36(1). So you add that to the cost of the asset because you have not commenced your business activity. Right? You add it to the cost because you have not commenced business activity. But the same Supreme Court in Karnal Cooperative has taken a slightly different view, of course, on slightly different facts. This is very important. They have said that where the FDs are given as margin money or collateral to the bank for raising loans, then the interest earned is also business income. So if you normally place a fixed deposit, it would not be business income. But if it is collateral or margin, then yes, it can be claimed as business income. Of course, if you lend money, and if your articles permit you to do so, I think lending money can be business income. The next issue is with regard to a case where a person or a company has advanced loans to its shareholders. Now, what happens is long back they advanced money to shareholders. They now are literally saying, well, we'll write it off or we don't want the money. Now, what is the implications of this? Now, on the one hand, I would think if there are accumulated reserves, then the provisions of 222 will get attracted in the hands of the shareholder. If there are no accumulated profits, no problem. But if there are accumulated profits, 222 will apply because this will amount to a distribution. Now, from the point of view of the company, of course, it would not be allowable unless you can show that you are a company which is engaged in money lending. If you are a company engaged in money lending, and if in the ordinary course of your business you have lent this money, then yes, you could claim it as a deduction under the provisions and claim, or rather you would claim it as a bad debt. But then the next question is, what about the implications of 194R? See, 194R uses more or less similar language to what is contained in 28.4. Right? See, we will recall the decision of Supreme Court in a case called Mahindra and Mahindra, where what happened was a loan was taken and that loan was not repaid. Whether the provisions of 28.4 would be attracted was the question. The Supreme Court made an analysis of the provisions of 28.4 and said the language used is whether convertible into money or not. So if it is money itself, then 28.4 is not applicable. This was the interpretation of the High Court in the Supreme Court in Mahindra and Mahindra. Of course, from assessment year 24-25, the law has been amended in 28.4 to say that even if it is money, it can still be governed by 28.4. Interestingly, 194R has been amended with effect from 1/4/23 to include money. So the provisions of 194R came from 1/7/22. So from 1/7/22 to 31/3, if it was money, it was not governed because of the interpretation given by the Supreme Court in the context of 28.4. From 1/4 onwards, it will be governed by 194R. But then you have a very peculiar situation here. What happens is, up to 1/7, no problem, neither 28.4 nor 194R, because 194R was not even in the statute book. From 1/7 onwards to 31/3, again 194R was there. I'm talking of the year 23. From 1/7/22 to 31/3/23, no problem. 194R is not applicable. No TDS will be applicable if it is money. If it is not in the form of money, but in the form of something else, then yes, 194R will apply. But if it is in the form of money, 194R will not apply. Again, the amendment has a lot to be desired. It says for the removal of doubt. Now, is this retrospective or prospective? You cannot ask me to go and retrospectively deduct tax at source. I have already made the payment to you. If I come back to you and say, come give me TDS, where do I get it from? Not possible. So I would think, of course, there are decisions of the Madras High Court in the context of explanation 5 to 32(1), where they say merely using the words for removal of doubt does not make something retrospective. Be that as it may. Now, the difficulty which I see is that from 1/4/23, there is no doubt that 194R applies. But 28.4 applies only from 1/4/24. Because it is applicable from assessment year 24-25. No, it is applicable. So it is applicable from 1/4/23. Sorry. Now, so they have more or less brought this in tandem to ensure that TDS will also apply. It will become income also. So on the one hand, it can be taxed in the hands of shareholder under 222 if there are reserves. But if there are no reserves, then will it be taxable in the hands of the shareholder? The answer may be dependent on what the shareholder does. If the shareholder has borrowed it for his business or profession, then he is governed by 28.4. But if he has not borrowed it for his business or profession, then 28.4 has no application to him. So it will not be income in his hands. I am assuming there are no accumulated profits. But there will be a TDS for him. Because 194R does not say if it is governed by 28.4. They have just copied and pasted 28.4 there. The content of 28.4 without a reference to 28.4. So whether it is your business income or otherwise, the provisions will apply. Right? So the next difficulty comes when you say, look, provisions apply all right, but what will I do after you deduct TDS? It is not my income. I should still be able to claim credit. Next, what if you have not deducted? Now 40A1 and the provisions relating to 201 have been amended to say that if I have included it in my income and paid tax thereon, you will not be treated as an assumed default and there will be no disallowance on you, but I will not include it as my income because it is not my income. Because I am not borrowing it for my business or profession. I am not even running a business or profession. Right? So if 222E is applicable at least, it is possible that I will offer it as income and claim the TDS. But if there is no accumulated profits, this confusion again arises. The next aspect is with regard to loans, where you go for one-time settlements with the bankers. Of course, insofar as interest is concerned, you may have had it disallowed under 43B. If it was disallowed under 43B, 41(1) has no application, no problem. Right? What if it was not disallowed under 43B? It will become income under 41(1). No difficulty there also. What about the principal amount, which is waived? Now, the principal amount that is waived, whether it will constitute income or not, post-amendment made in the provisions of 28.4, I would think it can probably be taken as income because money can be taken as income. But pre-amendment, one can take the benefit of the decision of Supreme Court in Mahindra and Mahindra and claim that it will not be allowed as it will not be treated as a income. The next issue is with regard to shares issued at a discount. What happens, say I may issue shares at par and redeem it at premium, or debentures at par and redeem it at a premium, or issue it at a discount and redeem it at par. Now, the Supreme Court in Madras Industrial Investment Corporation would say that the difference, say supposing I issue for 80 rupees and redeem it at 100 rupees, the difference of 20 rupees can be claimed over the life of the debenture. So, supposing I'm carrying on or I'm going to redeem this debenture after 5 years, I can claim this 20 rupees over 5 years equally, 4 rupees in each year. What about the TDS requirement? Interestingly, in the context of zero coupon bonds, the board issued a circular saying TDS will be only at the time of final dispersal. Right? Now, this was applicable to zero coupon bonds. Clarifications were sought with regard to debentures. The board came out with a circular again, saying that this is applicable to debentures as well. Right? Now, there was one problem, that the circular talks only of a public company. It does not talk of a private company. What happens to a private company? Should they deduct tax at source? I have in my possession personally one clarification by the board itself. One private company by name Emerald Testing Private Limited approached the board for a clarification. A personal clarification was issued to Emerald Testing Private Limited saying TDS is only at the time of redemption. Right? So it is applicable to a private company also. In fact, citing this, I have won cases in the tribunal also. So if anybody wants a copy of that, all you have to do is call me or mail me and I will happily share that, that letter that was sent by the board to Emerald Testing Private Limited. It happened to come to my hand through some, however, I knew Emerald Testing, so I got it. Of course, I have one more complication. What happened is at the end of the 5th year, I didn't redeem. I decided to convert the debenture into share. Now what happens? We are still fighting. Time will tell the answer. Next is tax deducted, not deposited, or tax not deducted but deposited late, or a case where tax is not at all deducted. Okay. Now, what happens in a case where tax is deducted but deposited late? Obviously, if it is beyond the due date for filing the return of income, the disallowance will operate. It will get allowed in the next year, in the year in which you make payment. That should not be the expenditure itself. That should not be an issue. Of course, there is only today a 30% disallowance if you are a resident. Non-resident, it is still remaining at 100%. Now, the next aspect is for failure to deduct. There is a penalty under 271B. Similarly, for a failure to or a short deduction, you can be treated as an SC in default. But whether 271B is applicable or not is a larger question. I don't want to enter there. But you will notice that prosecution is only in a case where you have deducted and not remitted. If you have not deducted, there can be no prosecution. I won't understand why this matter traveled up to Supreme Court. I also have a number of prosecution notices which have been sent to SSEs for delayed remittances. There is no prosecution for a delayed remittance. The prosecution is for non-remittance. If there is a delayed remittance, there is interest, there is penalty. There is interest, there is penalty. Non-deduction. Interest, there can be penalty. That's all the way I will have to look at it. The next is with regard to directors' remuneration, where directors are paid a percentage of net profits. Many officers are taking a view that this is excessive and unreasonable. Now, whether something is excessive or unreasonable, the assessing officer first, the burden is on the AO to show that these are the comparable instances that I am taking. Based on these comparable instances, I find it excessive and unreasonable. But interestingly, there is one very old circular of the board, circular number 6 of 1968. Right? This circular was issued 2 months after I was born. Right? And the circular is still effective, where they clearly say if something is allowed by Companies Act, then income tax should not make a disallowance. And I think this can be applied to every law, not just company law. Wherever any other law permits a particular amount, sum to be paid, that should normally be allowed for income tax purposes also. But watch carefully, if the officer can demonstrate that no services were rendered. If the officer can demonstrate that no services were rendered, then possibly he could disallow the whole of the sum, because he is not invoking 48(2) there. He will straight away invoke 37(1) and say no services are rendered, therefore I seek to make the disallowance. I have been told that I should break for tea. So we will break for tea. How much time, sir? 15 minutes.
We can break for tea now and reassemble within 15 minutes.
So after the tea break, well, I have been warned already that I must close at 1 o'clock. So you can rest assured that I will close at 1 o'clock and you will get your lunch at that hour. Well, the next issue is with regard to cash payments. Now, we will all understand that 40A3 makes a disallowance in respect of cash payments. And if you look at the provisions of 40A3, it does not only refer to the Rule 6DD, but it also talks about business considerations. So there have been a number of decisions where they have held that even if a particular item of expenditure does not fall under Rule 6DD, if there are business circumstances where cash had to be paid, then it is still allowable. For example, there is a decision of the Gujarat High Court in a case called Anupam Teleservices, where they were laying these cables in very remote places. And there they had no choice but to pay in cash. They said business considerations, we had to pay in cash, it was allowed. Likewise, we have a case of the Chennai tribunal, a case called Safeway dredging, which I only had the opportunity to argue, where what we do is when there is dredging and something happens to be done, we just get the fishermen folk locally who help the company out in the activity. And the question was whether it is allowable. The tribunal said it is allowable. Unfortunately, I was party to one more decision, which is called Vaduganathan Talkies, where again similar cash payments were made by a distributor of films. There they said you have not demonstrated business considerations, necessity as a result of the business, and they did not allow the expenditure. I only argued. And that has been affirmed to the Madras High Court as well. So you have to be very, very careful. If it is not coming directly under Rule 6DD, you have to ensure that you are able to place on record as much evidence as possible to show that business considerations were there, in which case there should be no difficulty in claiming the expenditure as deduction. The next issue again arises from a decision of the Madras High Court, where I have my own doubt on the aspect relating to how the provisions have been invoked. See, what happens is that in that case, the assessee closes his business in 2012. When the assessment is happening for the assessment year 1920, the assessing officer finds that credits relating to earlier years, he has closed the business activity, is still lying as creditor. So the assessing officer writes to the creditors don't respond. The assessing officer seeks to add this under 41(1). Obviously, these are trade creditors. The question of 41(1) applicability does not arise because you would have claimed the purchases as a deduction. Right? Of course, I have one more dimension to this. Supposing the purchases had remained in stock, then I would not have claimed a deduction. Because whatever purchase, I make a purchase of 100 rupees, 30 rupees remains in stock, only 70 effectively is claimed as deduction. So that aspect did not get looked into, but keeping that aside, they presume that it would have been allowed for a minute. And then the question of 41(1), the High Court says since the creditors did not respond, it can be treated as income under 41(1). I have always had one reservation with regard to 41(1). See, 41(1) no doubt says that if an amount has been allowed as a loss, deduction, or trading liability, then if there is a subsequent benefit derived, that amount should be treated as income. There is no doubt here. But then it should be treated as income when? In the year in which the benefit is derived. Why does the officer or the High Court presume 1920 is the year? What if the assessment had been taken in 1819 and similar thing had happened? They would have upheld it in 1819. Supposing 1920 had not been taken for scrutiny, 2021 had been taken up, and that year the same circumstances had happened, it would have been treated as income of 2021. It is not that somebody can treat it as income in any year. They have to treat it as the income of the year in which the benefit is derived. That aspect has not been looked into at all. I would think that aspect is very important. The next again is with regard to a company which sells residential property, and some of it was where an agreement was entered into in an earlier year, but the sale deed as such was registered in a later year. Now, what happens if there is a change in the guideline value? The provisions of 43 CA itself very clearly say that if any amount has been paid through banking channels, check, draft, whatever banking channel, if any amount has been paid at the time when the agreement was entered into, that day's guideline value can be taken. So there should be no conflict here, so long as the amount has been paid in or through banking channels in that year, some amount, whatever, even if it is 100 rupees, it is fine. Next is a case where the question of applicability of 4713B I have looked into. What happens is a company is being converted into an LLP, but one of the conditions stipulated in 4713B is not satisfied. The taxability. So now you can look at the taxability in the hands of the predecessor company, because the predecessor company which is transferring the assets to the successor partnership firm. Now, the first thing is what happens in a conversion of a company into a LLP. If there is a reserves and surplus, then that reserves and surplus gets classified as capital in the hands of partner. So to that extent, one can say that there is some consideration received by the partner. Right? Now, but look at the partnership firm. Assets have been transferred, no doubt. No doubt assets have been transferred. But what is the consideration that the company receives? Nothing. Nothing. It is just that the company has been converted into a LLP. Now, once you say consideration has not been determined, then the computation of capital gains fails. You will all recall the old decision of the Supreme Court in 128 ITR, Srinivasa Shetty, where the Supreme Court held that if an amount is, or if the computation fails, then the charge fails. Now here I would think that the computation fails and therefore the charge should prima facie fail. But then we need to look at the implications of 50C and 50D. 50C, which talks about what if it is land and building. If there is land and building, 50C requires you to take the guideline value. Likewise, 50D says if the consideration is not determinable, then you take the fair value of the assets to be the consideration. Now, interestingly, both these sections say consideration is received. In 50C, for example, it says consideration is received or accruing, but is less than the guideline value. So there should be a consideration. If there is no consideration, still 50C has no application. Next, if you go to 50D, again it says consideration is received or accruing, but is not ascertainable, because there might be an exchange of assets, etc. So there also consideration should be received or accruing. Now I have no doubt in my mind that there is a transfer from the company to the LLP. But I would think that since the computation fails, the charge fails. My good friend Falguna Kumar and I were having tea together, and he threw an allegation at me. He says, you have become an advocate, so you are creating case laws for your future. I told him there is no problem. These are all controversial areas which I have touched on. Why don't you agree with the department? Right? He says, no, how can I do that? Then come to me or to anybody else, not to me necessarily. Right? So he will not agree with department also. He does not want to litigate also. It doesn't work. One of the two you have to do. You decide on all these controversial areas. If you decide consideration is not determinable, but I will take fair market value and pay tax, pay tax. Why would I stop you? I'll be very glad. I'll be very glad. But if you don't want to pay, don't pay. Srinivasa Shetty, we will try. That's all I can say. The next issue is with regarding 35(2)AB. Now, there is a very interesting thing on 35(2)(ab) that you must notice. 35(2)(ab) allows a weighted deduction. It was earlier 200%, became 150%, whatever percentages were there. It is a weighted deduction in respect of amounts that are spent on scientific research. Now, 35(2)(ab) very clearly says that you must get the approval of the DSIR. Right? So, a scientist there will certify that you are carrying on scientific research, and he will examine whether it falls within 11th schedule of the Income Tax Act. In the certificate itself, he will say that it does not fall under 11th schedule. And he will also certify the quantum of expenditure that you have incurred. Right? And on that basis, the officer allows the deduction. Now, I have had cases where after the officer allows, 263 has been invoked on the SSC, and the commissioner says this is an article or thing which falls under the 11th schedule. Of course, on merit, we were trying to say it does not fall under 11th schedule. That's a separate thing. But in law, the argument was very, very simple. You look at the provisions of section 35(3). It very clearly says if there is a dispute on either the quantification or whether it anything relating to 35(2)(ab), including 11th schedule, quantification, anything. If there is a doubt on the eligibility of an SSC, the CBDT must write to the DSIR, and the DSIR will alone take a decision on that. And that has to be followed by Income Tax Department. And that has to be followed by Income Tax, because Income Tax Department officer does not know science. He is expected to know income tax. He is not expected to know whether a particular article falls under 11th schedule or does not fall under 11th schedule. He is not expected to know whether a particular expenditure is scientific research or is not scientific research. I have had peculiar situations. One officer says, you provided car to scientists. Car expenditure is not scientific research. I said, the scientist has to be happy. The scientist has to be happy. We have to give him a car, otherwise he will not come to work. If he does not come to work, what research I will do? Of course, today you can work from home, but still you must provide internet charges, something. Right? Be that as it may. Then he says, the scientist would have definitely used it for personal purposes. For him, it is personal. For the company, it is official expenditure. That is all. If I provide my staff a bike or a car and they take somebody, their family around, how is it my personal expenditure? This is like an argument that I was raising where, I was arguing a case where somebody was running a Kalyana Mandapam. And the department says that this is any other object of general public utility. I said, you may call it any other object. But what general public utility can arise from my marriage? I don't know if my wife will agree that she had any use out of it. Forget others getting any use out of my marriage. This is literally what I had to tell. What public utility will arise out of two people marrying? Right? So, there are things that we will see as when you actually argue, some things can be real. We don't know what to say. Now, likewise, when we used to argue 80 IB 10, they used to say this person is not the developer. I said, okay, I am not the developer. Tell me who is the developer. There is a property standing there. Somebody should have developed it. If it is not me, tell me who. I will withdraw my case and go away. But they will not tell you anybody. They will say nobody has developed it, but how did that come? Anyway, so you can remember the provisions of 35(3). Now here, there is one more twist in the tail, which I have taken as the next issue. See, what happens is the DSIR issues what is called a Form 3CL, which Form 3CL is sent directly by the DSIR to the CCIT or the PCCIT. Now, the question is, if they don't send the Form 3CL, they would have certified my thing in Form 3CK. But they are supposed to send the Form 3CL. What if they don't send the Form 3CL? I would have thought that they send or don't send. That is between them and the department. I can't do anything. But there is a tribunal which says that if the 3CL has not come to the PCCIT, you can disallow. I am quite surprised about it. But the same tribunal in the same decision says if the claim were made under 35, not 2AB, but under 35(1), which is not a weighted deduction, then it is allowable. I don't think that can be a logic in that, but that's how they decided. The next is in case of an amalgamation or demerger, whatever form of thing you may take. I have taken the example of a demerger where there is a demerger sale. And let us assume that the income will vary as a result of the demerger. What happens is the Supreme Court in Marshall and Sons would say that the appointed date will be the date fixed by the shareholders unless the court changes the date. So if the NCLT gives a different date, that date, otherwise whatever date is there in the scheme as approved by shareholders will become appointed date. Now, until the NCLT passes an order, the returns will continue to be filed by the two entities as though no demerger has happened. But NCLT will pass an order today saying that the demerger is effective from 1/4/21, 1/4/22, whatever. What am I to do in all those circumstances? Now, in all those circumstances, there is a lot of confusion. Interestingly, they have brought in a new section 170A, which says that the successor can file a return, amend the return after the NCLT passes the order. So, which means I have to first write to my officer, a window would have been closed. So, I have to write to the officer to enable the window. That is one part. Now, there in 170A, they use the word entity, successor entity. So, first of all, in my understanding, that will apply only to the resulting company. Now, the income of the demerged company will also vary. For example, let us say there is a house property or a property income which goes from the demerged company to resulting company. Resulting company would not have paid it, shown it as income. Demerged company would have been showing it as income. So they have to amend their return. What should they do? Now, there I found an interesting decision of Supreme Court in a case called Dalmia Power, where the Supreme Court says that the demerged company, that was a case of amalgamation, whatever it be, they say that the demerged company does not have to make an application under 119 at all. The power comes as a result of the scheme itself. But then remember, my window would have been closed. So I have to go begging. Earlier, I could have simply filed a return or say if they don't accept it, send it by speed post acknowledgement and be done with it. But now what do? I have to go begging, asking them to open the window. Now, what I have advised people is, one, you go begging. Two, you also file a 119. Supreme Court only said there is no need for a 119 petition. It does not say you are barred. In that case, assessee did not go under 119. And the department argued that they should have gone. The Supreme Court said the fact that they did not go is not required because the scheme gives them the power. Now, the third person is the shareholders. Now, the shareholders' incomes will also vary. There can be two kinds of variation. The shareholders' income may increase or the shareholders' income may decrease. Because in that exchange, assuming it is not 219AA compliant, if it is 219AA compliant, capital gains won't arise. But if it is not compliant with 219AA, then capital gains will arise in hands of shareholders. Now, if there is time to file revised return, there would be no problem. A revised return can be filed. If there is an increase in income or decrease in income, the next question. If there is an increase in return income and if you want to file an updated return, pay the extra amount, then it is fine. But Malgunna Kumar would advise his clients to pay the updated return 50%, 25%. Big man. But most of us here may think, why pay that extra amount? So the next debate is, can I go under 119 in the hands of the shareholder? Now, if you see 119, If there is a reduction in income because the transfer results in a loss, then I think 119 there is no difficulty because 119 says the benefit can be extended. The time limit can be extended if there is an exemption, deduction, refund, or any other relief. So, if I have a loss in the transaction, I can approach the board saying any other relief because I want my loss carried forward and I have not filed the return within due date. But if I have an increase in my income, the section says exemption, deduction, refund, or any other relief. If I am going to increase my income and pay taxes, can I go under 119 at all? Is the next question. I would think that the board should be more pragmatic and saying that any other relief should obviously include even increasing income. Because otherwise I would be liable to pay the extra amount by filing an updated return, or if even that time has gone past, I would become liable for various penalties, etc., and interest. Right? Therefore, in order to avoid all that, probably the board should take a more pragmatic view. The next is again a case of amalgamation, where the subsidiary has MAT credit and unabsorbed depreciation. What happens in the hands of the amalgamated company? Can the unabsorbed depreciation of the amalgamating company be claimed by amalgamated company? Unabsorbed depreciation in business losses can be claimed if it is 2(1)(b) compliant. That is, the amalgamation is within the meaning as contemplated by 2(1)(b) of the Income Tax Act, meaning all the assets and liabilities of amalgamating company should become assets, liabilities of amalgamated company. All the at least 75% of shareholders of amalgamating company should become shareholders of amalgamated company. They should not derive any benefit otherwise than by way of shares of the amalgamated company. If these conditions are satisfied, and if the conditions in 72A are satisfied, then the unabsorbed depreciation and the business losses can be carried forward. Other losses cannot be. And remember that in so far as 72A is concerned, a fresh lease of 8 years will be available for the business losses, which is not available in case of demerger. Demerger is only for the remainder of years. Coming to the next question, MAT credit. There is no express provision in the Income Tax Act to provide that the MAT credit of the amalgamating company can be utilized by the amalgamated company. Therefore, in fitness, it would be ideal that you make it part of the scheme. A. Even if it is not made part of scheme, there are a number of decisions. But all that apart, remember that all assets of amalgamating company become assets of amalgamated company. And MAT credit is nothing but an advance tax. It is an advance tax paid by the amalgamating company. That is an asset of the amalgamating company, and that should get transferred to the amalgamated company. And therefore, the amalgamated company should be in a position to claim MAT credit. You will also see that when there is a conversion of a private company into an LLP, the provisions of 115JAA expressly in subsection 7 bar the credit being used by the LLP, which is not there in the case of an amalgamation. Next is in case of 80IA, etc., where there is a delayed filing of the Form 10 CCB. We have number of decisions, including now of the Supreme Court in JM Knitting Industries, where they say the filing of the Form 10 CCB for claiming 80IA, for example, is the time limit is directory and not mandatory. Therefore, one can file it even after the time limits contemplated, but of course before assessment, in which case it would be allowed as a deduction. The next issue is what happens if you have inadvertently failed to claim the 115BAA rates. Now, insofar as assessment year 2021 and 21-22 is concerned, the board has issued circular number 6 of 22 and circular number 19 of 23, where the board has said that you will be able to get the benefit of the 22% tax, even though you have not actually filed that Form 10 IC, but provided you have filed the return within time, and further provided you have exercised the option in that return. You must have filed the return within 139(1). So the board circular will help such of those assessees who have appropriately exercised their claim in their return, and also who have filed the return under 139(1). So these people in general will get the benefit as a result of circular. But such of those who have failed to file their return under 139(1) or have not ticked the appropriate column, the relief can only be by moving the CBDT under 119 independently. Right? So this circular will not be available. The next is on 56(2)(7)(b), where the shares are issued at a premium to residents and non-residents. The effect of 56(2)(7)(b. You will recollect that 56(2)(7)(b) was amended with effect from 1/4/24, that is from assessment year 24-25, to bring within its ambit non-residents also. So which means that the share should be at the minimum 11 UA value. So if you do collect anything more, see, this law has become so cumbersome. I still remember days when I did not even have to refer to Income Tax Act to give most of the answers that somebody called me to ask. Today I'm afraid. I'm really scared. I've become more experienced, but I find that the law is much faster than I am. It is much faster than I am. I am not able to keep pace sometimes. Every time I have to look at the act only. Now look at how the provisions are. You are to allot shares, say or forget allotting, because allotting is one controversial area I don't want to enter. Let's assume that you are selling shares. You have to sell it at exact value. I don't understand how it is possible. If I sell it at lesser than the market value, then the recipient gets taxed. If I sell it at more than market value, the other fellow gets taxed. The seller gets taxed. There is a problem either way. So how business does not operate on rule 11 UA. When I sit on a negotiating table with you, I don't tell you, okay, everything is as per 11 UA, you 11 UAA. Life is very simple. We will negotiate. Now, every single transaction, you take 50C. On the one side, for the person who is selling the property, 50C. On the other side, for the person who is receiving the property, 56(2)(10). See, they expect transactions to happen at guideline. It need not happen that way. Right? And it is so difficult for somebody to arrive at values. You know, if I and you decide to sell or buy a property, I'm going to sell, you are going to buy. It is simple. You will come and sit with me and say, this is the price I'm willing to pay. I will say, no, this is the price I want. Will both of us talk over phone and say 50C value? Fine, over. That's what the government wants. The government wants both of us to simply fix the 50C value and transact at that value. 50C itself somebody fixed arbitrarily. If the state government does not have money, they will increase it. If the state government has money, they will reduce it by 30%. If the state government feels a lot of black money is being transacted, they will again increase. There is no. In fact, I keep saying, people talk about method in madness. Madness should not have a method. If there is a method, it is not madness. And this 50C is exactly like that. Each state government decides what it should be. Now in Kerala, the guideline value is much lesser than the value at which it is transacted, whereas in Tamil Nadu, the guideline value is far higher than the value at which in many places at which it is transacted. So it is very impossible, but that's how it works. Now they have extended from 24-25, they are extending it to a non-resident also, the rules of 11 UA. And they have given a series of methods. I read it, I didn't understand. They have given some 5 methods and said these all should be taken into consideration, but the merchant banker should do. So anyway, I'm not a merchant banker. Why bother myself? Let him read and let him understand is the conclusion I came to. Be that as it may, all I wanted to say is 5627B up to assessment year 23-24 covers only residence, where there must be a justification for the value, and the value is it is provided clearly in 5627B. If you want to take a value higher, which is based on intangibles, etc., you can take, but you must satisfy the assessing officer. And B, it also permits the DCF method. Now, in DCF method, there is a next confusion. I choose the DCF. The officer, after 3 years, when he is actually making the assessment, he says, look, your actuals are not tallying with your projections. It should not tally. If I do exactly what is there in the projection, that means my accounts are not true and fair. How can I project something and do exactly that number? It should not tally. Right? If it tallies, there is a problem. And assessing officers have also tried to modify the method. I choose DCF, they say NAV. That is not permissible. The choice of the method is mine. You can pick a flaw in my method. For example, in DCF, you can still pick a flaw. But you must be able to demonstrably show. For example, let's say I have a hotel where I have rooms. Say I have 100 rooms in the hotel. Supposing I have taken occupancy at 300%, you can say your DCF is wrong. But if I have taken occupancy at say 110%, you cannot. Because 110% occupancy is quite normal, because I will check out at say 10 o'clock and you will check in at 10:15. So for you, they will charge extra because the normal check-in is 2 p.m. And for me, they will charge up for the whole day. So that is possible. A higher occupancy reasonably is possible, but it should not be smacking of malafides. That's all we can say. The next is with regard to additions made under 68 and the set-off of losses. Now, of course, 115 BBE is very, very clear that no such set-off can be made because you are now being taxed at that 75% rate. But even prior to that, I'm talking of earlier years, there were at least 2 decisions, one of the Gujarat High Court and one of the Chandigarh Tribunal, where they said 68 is an income that does not fall under any of the heads of income. If you see the heading itself, it says aggregation. It is because you don't know the source that 68 comes into play. So that source can be anything. I don't know. It can be salary, unknown salary. It can be unknown house property. It can be anything. So the Gujarat High Court says, and if an addition is made under 68, then no set-off is possible against that at all. Because that is not at all a head of income. That is not at all a head of income in the first place. The next issue is very, very simple. What happens if there is share premium collected or share capital collected? Should or can 68 be invoked? 68 is now permitted even in case of share capital. And the person from whom you have received, he should be able to prove, you should be able to demonstrate the genuineness, the identity, and the creditworthiness, failing which 68 additions are possible even in respect of share capital. The next issue is in a case of survey, where additions are made for sales outside books. What happens if there are sales outside the books? Additions are proposed, and the officer wants to invoke 115 BBE. Now, clearly, the officer comes to a conclusion that this is sales outside books, which means it is my business profit. No doubt he can tax it, but he cannot invoke 115 BBE because 115 BBE comes only in respect of 68 to 69C or D rather. And they talk of unexplained credit, unexplained investment, and unexplained expenditure. So long as that is not satisfied, 115 BBE is not invocable. But Supposing they find excess stock, they find shortage of stock, it is sale outside books. If they find excess stock, it is purchases not accounted. If purchases remain unaccounted, I would think that that can also fall under the provisions of unexplained expenditure. Source is not proved. In which case, the officer may be able to invoke 115 BBE unless you are able to show that you have done a rotation and that the unaccounted sales has resulted in the unaccounted purchases, but there will still be a seed. First, you would have bought for 10,000, you would have sold for 12,000. 12,000 you would have bought again, you would have sold that for 16,000. 16,000 you would have bought again, but that first 10,000 can still be hit by 115 BBE. The balance maybe cannot be hit by the provisions of 115 BBE. The next issue is again on unexplained expenditure and the impact of 115 BBE. I would think there should be no difficulty in concluding that 115 BBE will be applicable if you are not able to explain the source for the expenditure. The next issue is a small controversy that arises as a result of a conflict in the language in section 80 IA 12 vis-a-vis 80 IA 12A. Now, 80 IA 12 would say that you are not in the year of reorganization, the predecessor is not permitted to claim the benefit of 80 IA. First of all, let us understand 80 IA is in respect of certain specified incomes that are earned by an undertaking. For example, you have a windmill, you generate electricity, you get 80 IA benefit. Now, the first question that we need to address in the context of 80 IA, particularly in case of amalgamations, etc., is that the 80 IA benefit is not linked to the assessee. It is linked to the undertaking. So, if in a scheme of amalgamation, I take the undertaking from you, being the amalgamated company, I can continue to claim 80 IA for the remainder period. So, supposing you are entitled to 10 out of first 15 years, you have already exhausted 4 years, 6 years, the successor should be able to claim. Now, section 80 IA 12 and 12A are a little controversial because 12 and 12A have invariably been confused by the department. Now, what they seem to be taking as a view is that in case of section 80 IA 12, 12 says that the predecessor cannot claim any benefit of 80 IA in the year of reorganization. And 12A would say that there is no prohibition or the provisions of subsection 12 will not apply to an amalgamation or demerger after the first day of April 2007. So now we are dealing with a situation like this. Officers somewhere get confused. So what happens is, let us say for 4 years, it has gone past. The amalgamation happens in the 5th year. Now in the 5th year, who can claim the benefit of 80 IA? Subsection 12 says the predecessor cannot claim. That means the successor should claim for the year of amalgamation. From the next year onwards, no confusion at all. The successor will continue to claim because he is holding the undertaking. Right? Because he is holding the undertaking. This somewhere I think is creating a lot of confusion. The department seems to understand that subsection 12 acts as a prohibition from claiming 80 IA by both parties. But very close reading, to my understanding, says otherwise, and there is a Madras High Court on that point as well. Next again is on 80 IBA, where one of the conditions is satisfied. If you look at 80 IBA, it talks of making or constructing, developing small housing projects. And it allows a deduction. There are conditions. It says, for example, not more than one house property should be registered in the name of one individual. And it says spouse also. Supposing somebody comes to me and does not tell that he is married to so-and-so, I will lose deduction. Because somebody does not want to tell who his wife is. You will buy one property, your wife will come and buy the property. How am I to know you are husband and wife? Because you will give your address. If she gives her father's address, what am I to do? Right? All this is something, but for the time being, what happens to the benefit of the deduction? Whether 80 IAB can be claimed or will it be lost? Now, in the context of 80 IB, there are a number of decisions where the courts have held that only proportionately you should disallow. That is, if one case there is a violation, for that one case, you take the profit, take pro rata deduction. That's what the courts are saying. That is insofar as 80 IAB is concerned. 80 JJAA. In fact, starting from where it is classified, it's, if you look at chapter 6A, there are 3 categories. And this falls under deductions in respect of certain incomes. 80 JJAA is wages paid by me. How does it fit into a deduction in respect of an income? Now, if you take many of the other sections, 80 IA, for example, I earn income from a windmill project, which is a specified undertaking. Here I expend. I don't know why at all it should fall under that head, but it falls under that head. And if you read 80 JJAA, it is absolute confusion. When and how the methodology, the computation, in fact, I have been fighting so many cases where the chart accountant has certified a number based on some understanding. But when actually we sit down and read it so thoroughly, we find that probably the computation is not correct. We also don't know exactly what the answer is. But simple issues, I thought I will just address a couple of issues here. One is what happens during probation period, whether you can take the period, supposing I enter on probation in your company and all other conditions are satisfied. Can I take it, or can you take it that you have engaged a new employee? To my mind, the answer is yes. It does not differentiate between probation and ultimately taking the person. So long as he has worked for that specified number of days in the financial year, it should be fine. Next is what happens in PF registration. Now, we are facing this in a number of cases. Companies are taking people on probation and they have a policy that they are taken as some kind of apprentices or whatever name they give it. And they are of the view that PF is not applicable until they finish the probation period. But then when it comes to 80 JJAA, it requires that the employee should be under the PF. So what happens is, if in the first year, I take a person on employment and I don't bring him under PF in that year because he is in probation, I don't get the 80 JJAA in respect of his payment of salary. In the next year, I enroll him with the PF. Can I claim in the next year? The answer is no again, because he is not a new employee. Because he is not a new employee. This is the conflict that arises there. The next is again a very, very simple issue. And a company transfers agricultural land and has capital gains arising as a result of transfer of agricultural land. Assuming it is agricultural land and it complies with all the conditions in 2(1)(b), it is exempt. Just like agricultural income is exempt. But there is a small difference. If it is agricultural income normal, right, then it is exempt under 10(1). Therefore, MAT will not apply. But if it is agricultural land transferred, then there is no exemption under 10(1) specifically applicable. The Kerala High Court says, since there is no specific exemption under section 10, MAT tax will apply. Even in respect of that, I don't agree with that though. In fact, Madras Tribunal has held in favor. I don't agree with the Kerala High Court. But there is a Kerala High Court which says that MAT will apply. To my mind, that is also agricultural income. That is also exempt under 10(1) only. Otherwise, where do I get the exemption? See, they say it is not treated as a capital asset. Therefore, transfer does not arise. Of a capital asset does not arise. Therefore, capital gains does not rise. That is the concept that they are trying to take. But when I sell an agricultural land and earn income, that is also agricultural income. I don't see how that is not agricultural income. In fact, there are a number of decisions where the issue has been that a capital asset is sold. And when the capital asset is sold, there is an income earned. The act may require you to charge it to tax under the head capital gain, but nevertheless, it retains its character of being a business income. Right? There are any number of decisions on this concept. So I would think that the Kerala High Court decision should definitely be reconsidered. The next is what happens. Next issue is what happens if there is MAT credit and you want to opt for 115BAA. The minute you opt for 115BAA, remember that section 5A of 115JB would prohibit you from carrying forward the MAT credit that is available. So if you want to opt for 115BAA, you use the MAT credit and then come to 115BAA because that's your option. But once you come, you're gone. You can't go back. So you lose the MAT credit once and for all. The next issue is what happens in case again of amalgamations, where the assessing officer continues the proceedings in the name of the amalgamating company which goes out of existence. The Supreme Court in Maruti Suzuki would say that if the assessing officer is made aware of the amalgamation, if he proceeded against the amalgamating company, the assessment is void. But if the assessing officer is not aware, then the assessment is not void, it suffers from an irregularity, and that is curable. Right? And that is curable. But then I was wondering what happens in the case of an individual who is dead. You can't expect him to go and tell the officer, I'm going to die, and then go and sleep in the graveyard. No, that doesn't happen. So I don't think there can be a case where, because there is no obligation for the legal heir to go and inform the officer either. Right? If somebody dies, they will inform friends and relatives, not the income tax officer, GST officer, etc. Right? He is neither a friend nor a relative. So, notwithstanding the fact that the officer is unaware of death, I would think the assessment is void. Now, why this is gaining much greater proportion is because the department is consistently stuck with one area. Everything is computerized. Now, the PAN will be active. They can issue notice only in the name of amalgamating company because the PAN is active. Even if they are informed that the company has gone, unless the PAN is deactivated, the system does not allow them to issue notice in the name of amalgamated company. So this has become a much larger issue today after the system becoming entirely computerized. Number of notices in the name of amalgamating company, and they are being held to be invalid, provided the officer is aware that there has been a case of where the officer is aware of the amalgamation. He has been informed of the amalgamation. The next may not be directly in the context of a company, but I'll cut the long story short. I have made it slightly more long winding, but to cut the long story short, it is very, very simple. Does the concept of change of opinion arise even in the context of the new 148 regime? See, earlier 148, reason to believe that income chargeable to taxes, escaped assessment, etc. Supreme Court, Kelvinator of India, all of us knew change of opinion is applicable. Whether it is within 4 years, beyond 4 years, that is not a question. If an opinion has been formed, change of opinion is impermissible. Right? If you read the Income Tax Act, nowhere the Act talks about a change of opinion at all. It is judge-made law in Kelvinator. Okay? And that has been followed in a number of cases also. Keep that aside. Does it apply to the new procedure? There is a interest. I have from day one been saying it applies even to the new procedure. There is interestingly a Bombay High Court in Kolkata Knight Riders, in Knight Riders Sports, not Kolkata Knight Riders, where Kolkata Knight Riders should be in Kolkata, hopefully. But be whatever the name be, the Bombay High Court says that change of opinion will apply even under the new law. From beginning, I have been saying on first principles, forget all these decisions, change of opinion will apply in new law. It will always apply because only a constitutional court has got the power of review. Every quasi-judicial authority only has the power of rectification, that too if permitted by law. For example, Income Tax Act, you see 154. You see 254(2), which permits the tribunal to rectify. You see 154, which permits any other income tax authority to rectify. That power should be there, and it should be there in the act only. Right? No quasi-judicial authority can have the power of review. And when you reopen on the basis of change of opinion, it is nothing but a review. You held a particular view today. Tomorrow you want to do a different thing, you are reviewing your own order. Therefore, change of opinion will apply even under the new law, is my view. The next again is on 194R, where a bank, say for example, or any other NBFC gives a gift to a company in exchange for the company depositing its funds with the bank. What will happen? I would think that after the amendment in the hands of the company, 28(4) will apply. And from the point of view of the bank or the NBFC, 194R will apply after the amendment. Prior to the amendment, well, Mahindra and Mahindra, you could always say that if it is in cash, the benefit of Mahindra and Mahindra will be available. But if it is in kind, 28(4) would have been attracted. 194R may not have been in the statute books. Now, what will happen if the gift or whatever is given not to the company which is placing the deposit, but to an executive in the company? There can be little doubt in case of 28(4). 28(4) is applicable only if a benefit or perquisite, whether in money or money's worth, is received in the course of carrying on a business or a profession. If it is not in that course of carrying on a business or profession, in the hands of the recipient, 28(4) will not apply. Next is what will happen in the hands of the recipient under 56(2), particularly in the light of 56(2)(10). Again, I am doing an activity or giving you a benefit and I am getting back something. How can you say 56(2)(10) will apply, but still the minute you say you rendered some service and received the money, it is possible to say that it will still be income under 56 itself, 56(1) itself. So it may still be income in the hands of the recipient, even if it is an executive, but under the head other sources. 194R. Remember, 194R uses the exact words that are there in 28(4), but does not draw reference to 28(4) at all. It uses the same word, benefit or perquisite, etc., in the course of everything. And it does not fall under the head profits and gains of business or profession. So from the point of view of the person giving the gift, whether in your hands it is taxable, not taxable as an executive, is a separate issue. 194R will still apply. Right? See, even waiver of loans, we are having a lot of difficulties there. The last issue which I have taken is a case where this has been the recent decision of the Supreme Court in Nestle, where the lower rate of tax, whether it will apply. See, when a treaty is entered into, say, with an OECD country, the rate is prescribed at a particular level. And there are cases where when I enter into the treaty, I say that if I give a benefit to another OECD country, where a lower rate is fixed. Say today the rate between me and a country is 10%, India and the other country. I say that if I enter into a treaty with any other country at lower rate, then I will give the benefit of that rate to this first country as well. Now, majorly two issues came up for consideration. Of course, it's a very long judgment with number of issues arising, but majorly two issues, difficult to accept some of them, but Supreme Court. First is the Supreme Court was looking at the applicability of the provisions or the benefit of lower tax in a case where, or they were looking at whether a fresh notification under 90 subsection 1 has to be issued, or is it enough that the agreement has been entered into with a lower rate. I would have thought the minute you entered into the agreement, it would suffice for getting the benefit of the lower tax, even for the country with which I first entered into the agreement. But the Supreme Court says, no, a notification is required. Now, government has refused to issue notifications. The bureaucracy keeps quiet. They don't issue the notification at all. And the benefit of the lower rate is gone. See, this is something where one sovereign has given a promise to another sovereign. It is an agreement between two countries, not between two individuals, for us to talk all this. So, when I give a promise as India to a foreign country, I think I have to honor it. Either I must issue the notification immediately, or you have to accept that with or without notification, it will be there. Of course, one other issue that came up was whether that country, the second country with which I am entering into the agreement, should have been an OECD country at the time when I entered into the agreement with that country, or later became a OECD country. The Supreme Court says if it is later becoming a OECD country, that does not help. It should have been an OECD country at the time when the agreement was signed. Before I pause, one question that somebody asked me during the tea break, very quickly to answer it. See, the normal practice is that when a company is yet to commence operations but expenses are incurred, the entire expense incurred is normally capitalized to the assets. The question was, where is the provision in the Income Tax Act to capitalize it to the cost? There is no provision in the Income Tax Act at all. Right? But time and again, the Supreme Court has been holding in different cases on one aspect. They have been consistently holding, for example, Tuticorin alkalis, take the decision of Supreme Court in Chellapalli Sugars, series of them. Supreme Court, if you read these decisions, has been very, very consistent on one thing. Whatever is applicable to accountancy as a generally accepted accounting practice is applicable to income tax also, excepting where the Income Tax Act provides to the contrary. If the Income Tax Act provides to contrary, either through the Act itself or through its ICDS, then that applies. But if the Income Tax Act does not provide to the contrary, it is that the generally accepted accounting practices or the accounting standards need to be followed for a determination of the income of that particular entity. So there are a number of decisions. I was giving a couple of examples, Chellapalli Sugars, Tuticorin alkalis, all of them. In fact, you have the decisions which are there in various other cases where they have taken similar views. So this, I would think, is generally based on accounting practices. These are best practices. Otherwise, what will I do with that? I will leave that in limbo. I don't know whether it is capital, revenue, what I should do with it. And this is what the institute tells me to do. So what is true for accounting is true for taxation. If Income Tax Act provides to contrary, for example, if there are pre-operative expenses incurred even prior to the incorporation of a company, say 35D, go by 35D alone because there is a provision in the Income Tax Act. But otherwise, you go by whatever the Act provides for, right? Whatever the accounting provides for. I think I will pause here. Thank you very much. I promised I will close before 1. I'm just ahead of 1 o'clock. Thank you very much for the patient hearing.
Thank you very much, Banashekhar sir, for the wonderful presentation. May I now request our past chairman of SARC, CAE Palguna Kumar, to give us closing remarks.
Good afternoon, friends. I presume for the past 2.5 hours, what our learned speaker has presented to you is nothing but awakening your subconscious knowledge, whether to litigate or not, whether to interpret it in the other way or not, whether there are controversies on the subject or not. All these things through his deliberation, he has said number of, I think around 35 to 40 cases he has covered, sir. 41 he has covered. Tomorrow morning, and V. Ramnath is going to cover 22. And tomorrow afternoon, Kapil Goyal from Delhi is also going to cover some more things like this only. So these 2 days deliberations, his main intention is that lot of controversies are there, but an average CA tries to compromise and tries to quickly succumb to the department. Please avoid it. I have completed my 45 years of practice as CA. My experience also, just like our Banashekhar has said, nowadays in the faceless assessments, he has made 3 remarks. Number 1, the show cause notice says something, and next day the final order says something. I have also experienced number of things. The show cause notice says, under the business head 37 I am going to disallow. Please give your reply. You will definitely say object, no, it's not disallowable. He completed the assessment under 68, 69, something he will add and then complete this. It have been many of yours experience. But we have to litigate, we have to object, we have to protect the SSC. So number of controversies, especially in the past 4 or 5 years. The income tax computer is talking to the GST computer. GST notices being issued on more suspicion. So the income tax notices are also being issued under 148 capital. So for 4 years back, 17, 18, it seems you have a bogus purchase. What is your objection? The word bogus purchase is not defined in the Income Tax Act, only through some of the decisions. In fact, I have searched much on the word bogus purchase in the income tax decisions. There can be minimum four types of bogus purchase, different types. The income tax officer is not understanding what is a bogus purchase, because simply GST officer said, it seems you are having. They're still not yet concluded under the GST Act, but the Income Tax Act issues the notice and then starts passing order under 148 capital AD. Another one example, which my friend may be positive of time, he could not touch. After bringing in 2021, the partnerships 9B and 45(4), many of us may be still not able to understand the different possibilities of the interpretation of this section 9B and 45(4). Still amendments we are doing, admission, reconstitution, retirement, dissolution. But lot of questions are going to come, already have come, some notices have come. So a lot of controversies are also there. So the effort our speaker has put in is a good effort. And as a practitioner, unless we are thorough with all the provisions, what he has covered, right, though it said corporate cases, not only the head business, the other source heads covered, deductions heads covered, TDS sections is covered, especially the new TDS amendments 194R. So number of things he has covered. The other income also 68, 69C. So majority of the officers, whenever you are not able to prove the expenditure, as is quoted. For every expenditure, the officer expects substantial, concrete evidence for the expenditure. But the number of courts said there should be a reasonable evidence for expenditure. You cannot expect a substantial, concrete evidence. In the real life business, she said, businessman takes his business decisions. Why the officer is worried? How do you do this business? What sort of evidence you have got this? It is not the business of the thing officer. But we have to agitate as practitioners, unless we are thorough with the law, unless we are thorough with this latest issue. What all he has cited in the 2-3 years decisions, all that he has covered. So with all his wisdom, he has given us an eye-opening session. I think we can all join hands to appreciate him. That's how I conclude. Thank you so much. I thank the chairman and the SRS members for giving this opportunity. Thank you so much.
Thank you, Palgunu Kumar sir. May I now request Palgunu Kumar sir and the SIRC chairman Pannaraj sir to jointly present a memento to T. Bhanushekar sir. So with that, we have come to the conclusion of pre-lunch session. Let us break for lunch and reassemble.